Well, happy Financial Fitness Friday. Disclaimer, this is meant for educational purposes and is not, specific. Don't take this as specific recommendations or advice on investing. And this is kind of a controversial topic, I'd say, on ESPP and RSUs. When do you sell, that kind of stuff. So, but the but if you do have specific questions, that recommend, reaching out to a fiduciary, financial advisor, tax professional, or attorney for specific recommendations for your situation, since personal finance is personal and everybody's situation is different. Why don't we hit the poll? Okay, this is just quick. I'm making these polls shorter so we can get to the meat of it, but this is a quick 4 questions, so it should just take a second here. So first question, do you contribute to ESPP? And the majority actually max it out at 5%. You can contribute up to 5%. And if you're at a great salary, there's a maximum contribution you can do of $25,000, but most people aren't impacted by that, sadly. The 2 out of 7 do not. And then some people don't have ESPP at the company, understood, but hopefully this will help as you understand in the value of ESPP. It's like free money, almost similar to a match, but different. Okay, next question is if you stopped or decreased. So a lot of people at Viasat stopped it when because the stock plummeted for years. What did you do? Did you invest or that savings elsewhere? Okay, a third did in a diversified portfolio. Good. Saved in a regular savings account. Ouch. You at least go to a high yield savings account, but I would recommend going, like if you were already putting in equities, then put it in a diversified portfolio is preferred, but it depends on what you need. If you need the money for something that's coming up soon, I understand that. Spent it, that's good. Nobody did, they said. And good, a third kept their ESPP contributions. I know people lost money on when the stock for Viasat dropped, and they hadn't sold, but we'll talk about that. And what you can do if you had some losses, or you still have some that were at a very high cost, or down the road, just how to handle capital losses for your own benefit to make lemonade out of lemons. Okay, it's the third question. This was scroll. Do you contribute to the 401k to max out the match? 40% max out their annual contributions. 40% get the max but don't match it out. One says, I don't know. Happy to talk later, but if you work at Viasat, you need to contribute an average across the fiscal year of 10% of your paycheck to get the max match of 5%. So it does 50% on the dollar up to a maximum of 5%. So you got to contribute at least 10%. And then good, nobody said I can afford it, because if you can't afford getting that free money, then you need to look at your budget and make some adjustments, in my opinion. 4, what is the average return on the S&P 500 over the last 70 plus years? 20% said 5.5%. Good, nobody said a negative. One person said 20% said 20% gain, and then actually the majority got it right, 60%. It was 10.5%. And the S&P 500, as it looks like everybody knows, this is one you could have answered multiple. That's the Standard & Poor's 500, and basically it's an index that tracks basically the top 500, roughly that number. 500 companies, largest companies in the U.S. by market capitalization, which is the overall value of those large companies. So, okay, any questions on those before we continue on? Okay. I'll close that. The next thing, okay, here's the basic agenda. Real quickly, I'm gonna walk through, because people at Viasat are getting bonuses right at July. And so how our 401k works, our Empower, it's the same contribution rate that you have coming out of your paycheck. It applies to all bonuses, et cetera, as well. So if you want to keep more of that, you have uses for that bonus money outside of, the for your own use, then you need to go in the next week or so and adjust your contribution. So I'll show you how to do that. And then as soon as that bonus check comes in about July 1st, go back and readjust your contributions to make sure you're maxing out, as much as you can. But I know a lot of people get hit by that. I'm like, what? I didn't know that. Other companies have better setup or custodians where you can adjust contribution percentages, even like military TSP. You could do your base pays this percentage, special pays are this, et cetera. But some are not as flexible, shall we say. And so you need to know how to go in and make those adjustments as desired. Okay, and we'll move on. And if you don't mind, some people, if you have to drop early, if you don't mind taking a snapshot of this, it takes like 2 minutes to do the survey, but I'd really appreciate it. Lets me know if you guys are finding value in this, and if there's things you want to know or things that I can improve on, I'd appreciate it. So, okay. Now quickly we'll walk into. I'm just going through the starting pages. When you log on to the 401k, the Empower 401k, you want to go right to the account. Once you get to the account, it'll have a drop down, and you want to go to the BISET, 401k sharing plan, and go right to contributions. When you get to contributions, this is where it shows what your current contribution is, and it tells you all right there what the match is. But you can adjust this either by going in here and adjusting the amount, or by using the slider there and then hit continue. So if you say you were contributing 15% right now, and you're like, wait, I want more of my bonus money, I'm only going to contribute 1% because I want that whole bonus check, or 0. Go in, adjust it right there, 0 or 1, hit continue, then next. We have the choice, like most places, you can adjust what your contribution, how much is pre-tax here, which is traditional, versus your Roth contribution rate. So, just make sure you do it appropriately. Then you'll see what your actual contributions are. Hit confirm and continue, and now you've updated. As soon as that bonus money hits, go back and make sure you've readjusted your allocations. You'll probably miss one paycheck of those normal contributions, because we're gonna get another paycheck, and the bonus will hit about the same time. So you'll have a larger paycheck and that bonus, but then make sure you go in and you can maybe increase your allotment since you missed a paycheck than you had even before. Questions on that? I kind of went through that pretty quickly, but I just think it's important. And then just showing for people that don't know, here's a way you can set up auto increase if you don't already, if you're not already maxing out the annual contributions. Auto increase is a great way. Everybody gets raises, and if you keep spending your whole raise, you're just setting the goalpost further out. Save some of that and increase your contributions until you're maxing it out. But you can show right here. It's nice, tells you how much percentage you want to increase it by. Like a lot of people say, it's conservatively, they're like, oh, I'm worried they'll do 1%, but most people's raises are closer to 4%. So even if you increase it 2%, you're still taking home more, but you're continuing to take care of your future self better. Okay, and then here's another thing. People are like, I don't know how much I'm contributing. How much have I contributed? Am I hitting the goalpost? Like, where am I at? So if you go right to account overview, you can see what this was 2025, and this is an old thing, but you can see where you're increasing, and then like a bonus was coming in. So I adjusted it just to 1% temporarily. This was just a snapshot in time, and see, if I hadn't adjusted that, I would have only contributed this amount. And I'm like, oh, damn, I could have contributed 31,000 last year. So that's why as soon as that bonus check comes in, if you've made an adjustment, go back, update your allotment so that you get as close as you can to this value. Make sense? Questions? Okay. Now let's go. Now we're talking ESPP, and different companies have different plans. Some do every 6 months periods, some do 3-month periods, but I'm just going to go with what BISET does, which is 6 months, and it's kind of standard, and it's a good deal because it's 15% discount. Others only have a 10%. But it's weird, since we acquired Inmarsat and merged, we went from January 1st through June 31st to February 1st through July 31st. I don't know, something with the UK where it worked better to start on February 1st, but I don't understand it. But it doesn't really matter. It's still a 6-month period. So what it looks at is the closing price on the beginning date and the end date of that purchase period. And whichever stock closing price is lower on those two consecutive days, you get a 15% discount off that price. So somebody could probably look up, I didn't, but if you let's just say the stock for Viasat stayed the same right now through July 31st, you could look at in January, February 1st, it was definitely lower. So you're going to pay that February a 15% off that February discount price, which so it's not 15%, it could be 50% gain. Like it could be really significant. Even if the stock drops in price, though, then you're paying the lower on the later price. You're still getting a 15% discount there. So it's a win-win no matter how you look at it. It's just free money. So that's note that it is after-tax money that you're using. So unlike a 401k, if you use pre-tax money that lowers your, comes out before all taxes are, nope, you've already paid federal, state, FICA taxes, et cetera, Social Security, SDI if you're in California as well, all before that money that goes into ESPP. So you don't owe anything when you get the money released, the stock released to you at the once the period closes on July 31st. So that's why ESPP is so good. It's free money, just like a match. But if you hold on to it, which a lot of people did when Bicep had struggles after COVID, you can lose money. And so that goes into the plan of how do you attack what to do with the ESPP money or RSUs, et cetera, when they come in. Okay, that just what we're talking about. One, this is the problem with individual stock purchasing too. One, you don't want to put all your eggs in one basket, and especially if I don't want anybody to have more than 5 to 10% of their net worth from a company. Some say 30%, and that makes sense early on, maybe. If your first employer is that company, and that's much of what you're getting, I get that. But you want to limit that because one, what if you lose your job? Two, what if that company goes under? Everybody tends to be more bullish on their company than reality. So it's easy to be overly optimistic. But if you could lose your job, your livelihood, and your net worth all like that. So it's not worth having everything in one. That's why financial advisors, we recommend a diversified portfolio. Yes. Is there a way? Can you get super rich? Yes. That's why how secretaries became multimillionaires with Microsoft was through the Microsoft stock. Absolutely. But there's inherent risk. What about Enron? How many people freaking lost their whole livelihood because of that? It's just not worth the risk. You can take some of the gain and diversify it, and then you could hold out on some that's not going to ruin your life. But it could, if it shoots the moon, great, but don't risk your whole livelihood on that. So you could sell right away or hold, sell part of it. There's tax implications if on ESPP if you sell right away there, and we'll go into that kind of. It's not short term versus long term. It's similar. It's qualified versus disqualified, and we'll go into that. And it's a longer period. You have to hold that ESPP money, but in real terms, it's not that much of it. It's really an insignificant overall, and you shouldn't let the tax tail wag the investment dog. The investment's more important than if you instead held and lost thousands of dollars. Well, you screwed up there. It's not worth it. So just to make this example more clear, Boeing, and this is a little bit old, but Boeing got wiped years ago, and I don't know if you guys remember that. It was in 2019 when they had the issues. So imagine you're an employee, long time, you have 10,000 shares of stock, and retired five years ago, but you never sold. So that's your retirement plan, is that stock. Well, 5 years ago, it was worth nearly $4 million. Today, it's worth 1.5, 1.6. You've lost almost $2.3 million because you didn't sell and diversify. So there's just too much risk having too much in a single company stock. Okay, I'm giving some examples. This was yesterday, and I'm comparing the Viasat stock versus VTI, which is Vanguard's total U.S. total stock market index, which includes, it's over 3,600 companies in the U.S. 75% of it is basically the S&P 500, but then it has all the small and mid cap companies as well. So it's a great single ETF to have it almost a diverse, U.S. have the entire U.S. Uh, market captured in that. So man, this looks like we should just stay with Viasat, huh? Well, that was last month. Oh, sorry, this was 5 days of the stock. Look at how volatile that individual stock can be. Here's the last month. Um, and here's why it's good to diversify. This is since our peak back in May of 19. Look at what this stock did versus what BTI did. Significant. I mean, it's like over 106, like 154% gain, I believe, on this in those 5 years versus what you're still down, even though it's been, if somebody just started this since this last summer, it went from like $8 up to 72 recently. Significant gain, but you see how volatile it is. It's just not worth it. And that stock's anyway. This is an older example, and I just didn't want to. It's just easy to show this as a demonstration. This was back when Viasat stock was only $12, and I have this comparing to the Vanguard Total Stock Market Index, and you see how the blue, which is the Viasat stock, where it was dropping, but and this was the COVID hit, and then been pretty much up 2022 challenge, and then back up. But what you could do is, that's my point, is you could sell, buy the other, and immediately diversify that. That's just in one. I'd spread it out over, low cost global diversified portfolio, but this is just an easy example of showing what you can do as soon as that money comes in: sell, reinvest, and move on. So, okay. So real quick, I mentioned there in capital gains, there's usually short term if you sell within a year, and then versus long term capital gains, which is if you sell at least a year and a day later. Better tax treatment because you get capital gains tax rates versus ordinary income tax rates. The on ESPP accounts, it's qualifying versus disqualifying dispositions. And there's two rules, and it's a big and statement in there. And the one that hits you the worst is that number one, 2 years since after the grant date, which means, so in this current one, this current period starting February 26, you have to wait until February 2028 to be qualifying. 1 year after purchase, that's the normal, like, capital gains long and short term, which it would be nice because, I don't know, it's kind of frustrating that you have to wait another 6 months compared to normal stock purchases. But that's July 20, but it's both. So it's whichever is later, which you have to wait 2 years. So even once we get that money, like that stock on July 31st, you have to wait another 6 months till February 1st for it to be a qualifying disposition. And then we'll go into the differences of, you're going to pay ordinary income taxes if you sell it while it's disqualifying, whereas there's better tax treatment if it's qualifying. And we'll run through several examples. Just straight up capital gains. Okay, purchase price, what you bought whatever stock for. And if it goes up, there shows the increase in value, right? That's what your gain is. That's what your profit is. So your cost basis is what you purchased it for. This is your capital gain. So you just subtract the difference to determine what you're going to pay in total capital gains taxes. Is your total proceeds minus your cost basis gives you your gain. Okay, what if you lose? Well, if you same thing, basically you paid that much, stock dropped in price. You've got this cost basis still here, but um, the whole cost basis, and so this is a loss. The problem with the loss, it's not a problem, but you're limited to $3,000 of losses a year, and that'll lower your AGI. It's all carried forward though. Say you had $10,000 of loss, you'd have $7,000 that's carried forward. Each year you could use 3,000 of that. But there's a better way. If you had just a single stock, you could do capital gain harvesting on other things that you had gains and just wipe out that difference as well. But we'll go through that. Okay, let's see here. Okay, now we're talking stock plan transactions, which are different than just buying ordinary equities. Because you may, if it's disqualifying, you're going to have some ordinary income, even if there's a loss, which is kind of interesting. So here's the, because you get that discount, if you sell it during that time, there's going to be some portion that's going to be considered gain. So here's this, I don't even like how this is explained very well, but let me go here. Whoop, actually I will. I've got a better explanation here soon. Here's the capital gains rate, so just for various, and I've got a state map in a moment where you can see, but it's funny, Washington State used to not have a capital gains. Now look, now they're in the top 11, or and actually they're in the top 5 if you make over $1 million. So they've significantly changed theirs. I guess New York didn't like being number 6, so they bumped up theirs to 10.9%. They're back in number 2 next to California, the worst, which is a normal. California it's the same capital gains rate as their ordinary income tax rates, and that's okay. So here's just a map. This is 1 year. This is from 2024. So the numbers have changed a bit, but I just like how this one you can see quickly which ones are 0%, and it highlights the ones that are the worst, like California. Whereas this is from 2025, what shows what the current rates are with the adjustments, but it's can be significant differences of how much you're going to pay in overall taxes on capital gains, depending on where you sell it from. If you sell stock from a different, even an employee stock purchase plan and RSUs, that state, even if you move out, can charge you taxes on the portion that you quote earned while you're in that state. So that's a next level, the subject, but just, if you were to move something like that, that's something where you definitely want a tax um, professional to help. Here's an employee stock purchase plan, and give an example of just starting, the share price that's starting the period's $10 at the purchase date. So that'd be like for us on the 31st of July, 15. So you get the 15% discount. So you're going to pay $8.50 because you're paying a 15% discount off the lower of those two prices. And then in this case, you sold it at $22. So you've got to get gain right there. I use these numbers because this was an example I had from before with using actual numbers we had that you'll see in an upcoming slide how we figured out the taxes for that. For ESPP, as mentioned, this is after tax money, so you don't owe anything when you receive those shares. They're generally due when the shares are sold. That's different than RSUs, as you'll see, because RSUs are just straight up compensation. RSUs being restricted stock units. Okay. Now, this kind of graph, I think, kind of helps show that whole what's qualifying versus what's disqualifying. Like I said, it's that 2 years from the grant date that really kicks, that really hurts, that makes it longer. So even if then that's I think the most confusing part for people that understand equities in general, and that you have to wait a year and a day to sell to be long-term capital gains. This, you've got another 6 months because of that and on the 2-year grant date. Okay, here's how you determine how much ordinary income is recognized depending on whether it's a qualifying or disqualifying disposition. For a you can never have this less than zero. You can't, just because even if a stock lost money, you don't have less ordinary income, negative ordinary income. The lowest it can be is zero. But for the disqualifying, it's just always the fair market value at purchase minus the purchase price. So it doesn't matter what the stock price is now. It's what the fair market value was at purchase minus the purchase price. So you're going to pay those taxes anyway, even if you took an overall loss on capital gains later. We'll go through examples. Okay, here's that using those numbers that we showed earlier. The sale, you sold at $22. Their purchase price was, $8.50. So you got $13 per share. Or the low, but remember this for qualifying, it's the lower of the two. So grant date price minus the discount price, that's $1.50 per share. That's much better than $13.50 per share. So that's a good thing about qualifying. For the disqualifying disposition, it's going to be $6.50 per share, no matter what this, even this, that's going to be your ordinary income. You're going to pay at ordinary income tax rates, regardless of the fact that it's sold at 22. Okay, and then here we'll walk through just that qualifying disposition. As mentioned, the ordinary income was just $1.50 per share. So you sold 100 shares at $22, total proceeds $2,200. Price you paid was $8.50. The ordinary income, $150. And so your overall capital gain is $1,200. So I just did a couple of numbers saying, hey, assume a 30% tax rate. You've got $45 in tax in ordinary income. Then assuming like 15% federal tax rates, overall you're going to pay $336.60 on that. Now remember that for the next one. Okay, this is disqualifying. Same thing. Notice how much more ordinary income you've got. That's $650 of ordinary income. So that's going to be taxed at that higher tax rate. And then you've got $700 of capital gains, which has a better tax rate. Overall, though, you're going to pay 195 in ordinary tax. But when you look at the overall numbers, it's like $365 in taxes versus 336. It's really not that. It's really not that big of a deal. I mean, granted, we're talking just 100 shares, but these aren't thousands of shares anyway. So like I said, don't let the tax tail wag the investment dog. Do what's right for your situation and make sure you're in an overall globally diversified portfolio. Okay, let's see. RSUs. So RSUs, they used to have stock options have changed. Like some companies still do stock options where you basically get a grant and then there's a strike price and there's a certain window where you can exercise that. So, and it's only good if if the stock price is going up, and you can buy this stuff at a discount, but you're paying that strike, you're paying that price, so you're coming out of pocket to pay that, or you just don't pay if the stock doesn't gain. There's no reason to purchase it. Obviously, RSUs are just straight up compensation. There's a company either awards you a letter that has a dollar value saying, let's say, $10,000 of stock. Well, if it's a dollar value, then the stock price, closing stock price of the day of that letter determines how many shares that is, because that's really what it comes down to. So let's say it was, and I got the example up here, but normally most companies anymore, they have they offer you a certain number of shares, and that's just simpler. And then you get that many. Let's say you got. We'll just go through this example. You got awarded $9,000 and the stock price was $30 per share. In that case, you got you're going to get $300, 300 shares vested over 3 years. This is assuming a 3-year vesting schedule, 33% per year. Each vesting schedules vary. Some have cliffs where you have to wait that entire time to get any of it. Some have like 25% go at the first year and then a percent per month, which is kind of interesting. So there's different things. You just have to understand what your vesting schedule is. And this is often what is kind of golden handcuffs people see it, and that's why so many Amazon people work for about 4 days in a year because they get that last vesting period. Theirs used to be 4 years, and then they go do something else. But the ultimately you get shares awarded when you get those 100 shares per year. In this case, it's at that current stock price value. So if the stock was only worth $10, you only got $1,000 1 year, but then it jumped up to $50. Now you got $50 times 100 shares. Now that RSU is worth much more money, but it's straight up compensation. So you get taxed on it. Any bonuses or RSUs are taxed federally at 22% plus state taxes. Ultimately, it comes out to about 40%. I just looked; it was about 41.5% on the last uh, RSUs that I saw. But um, there's it's something. It's just basically considered compensation. So as soon as those shares vest, that's money that you have to pay Uncle Sam for. And we'll talk about the best way to do that, which is just have it withheld so you get fewer shares. Okay. Yeah, we kind of already talked about this, but yeah, basically it's about an effective 40% tax rate that you pay, on RSUs and or bonuses that you receive. Okay, now we'll go through an RSU example as compared to an employee stock purchase plan. So you got the same numbers. $10 was at the grant date, but by the time they were vested, like a year later, they're worth $15, and then you sell them again at $22. Okay, since this is already compensation, you're already paying taxes on what you get at the share price when it vests. Then when you sell, it's just RSUs are just like regular stock. If you sell it right away, within a year, you're going to pay short-term capital gains, which are normal ordinary income tax rates. If you wait a year and a day, then you get the preferential capital gains long-term, and you pay capital gains tax rates. Okay, so in this case, in this example, you've got, but when you receive, this is just showing the taxes that you're going to owe. 100 shares at $15 a share, you got $1,500 in compensation. Okay, assume they're going to take, which is what they will, about 40%. You'll owe $600 in taxes from those. Now, the best way to do it is have it just withheld. That's usually the default option. If you don't, you're gonna have to come up with that. You're gonna have to figure that, and you're gonna have to do estimated taxes too, because Uncle Sam wants their money when you earn it. So you could get hit with a penalty if you didn't do this. Don't do it. Have them withhold, and then so you don't see a huge tax burden later that you're not accounting for. Okay, just money never seen is money is the best way to do it instead of putting yourself in a hurt locker. Okay, questions there? Okay. Now we're looking at the capital gains because we sold those. In this case, we're selling 60 shares at $22 per share. Why did I do that? Oh yeah, because we withheld. So we had 100 shares. They withheld 40 to cover the taxes. And then, so now we have 60 remaining. So you sell the 60 at $22 a share. There's your proceeds, $13.20. Price paid. You've got overall a gain of, because you already got that ordinary income that you paid taxes on, $900. Subtract that off of your proceeds. Your capital gain is $420. Questions there? RSUs are a little more simple than ESPP. Okay.
Where do you go to set up the withhold to have it withheld?
Go right into if you're using E-Trade Morgan Stanley, you just go right in there and it has an option. And
Okay.
if you don't do anything by default, it will withhold the shares. And I
Okay,
would
thank you.
recommend not changing that. Okay. And same with anybody, any other company that's the custodian for that, just go in and you can see what the options are, and you just make sure it's automatically withholding. But that is the default. Okay, now just let's say you have a number of shares that you haven't, you just never did anything with them, and then but you're like realizing, hey, I don't want all this single company stock. So now there's better ways than just going and selling the qualified, the new batch that's disqualified. Now you want to go in and look and sell the batch that makes the most sense. Now, and here's the thing, once you have a company stock, every single share of that stock, no matter what you got it at, is worth the same amount. So while it might seem counterintuitive, take the loss if you need to sell, because it doesn't matter. You don't pat yourself on the back because you had a gain. Then you're going to pay more taxes. If you take the lowest value, if you take a loss of for the amount you need, or the least amount of gain, you're going to pay the least amount of taxes. And then we'll go into an example where if you actually had to sell and you sold at a loss, how you can sell something else that was at a gain, rebuy it, and not pay any taxes, but have a higher cost basis on that other stock or ETF. Okay, and here I'm just showing you where is it for E-Trade, Morgan Stanley, how to go in and figure out where do I go and buy and sell and figure out what batch I want to sell. So hit on the stock plan, and then I'm using an example of the employee stock purchase plan. Okay, look at all these batches. Now you can see what the price was paid for it. This is kind of confusing because it shows that, and this was from a while back, so don't look at these dates. These would obviously all be qualified. Actually, this would still not be qualified yet. No, that one would too. No, sorry, that one wouldn't. But what it says is long term, but that's actually inaccurate. So you got to be careful. You got to remember the 2 years since the grant date. But this is the most current one. And even though you would be taking a loss, look at, because it's disqualifying, you're still going to be paying this ordinary income tax on that difference between fair market value and the purchase price. Fair market value at the time you purchased it. So instead of doing that, pick where you get the biggest loser, as we'll go in, right here. Now if you chose this one, you're going to have a long-term capital loss of 1178 per share. That's, at 100 shares, that's $1,178. Vice paying income tax on an immediate 15% gain. It's just a smart way to, take care of your money if you still have old shares. See, if you sold it at the higher cost basis, disqualifying, you're going to pay $464 per share on income. And then even if you had this, and you still have a loss, but this was a weird one. So it said long term, but it wasn't. And that's why you had to understand the dates, and that's where when you click through these, you can see, because long term would imply that it's qualifying, but it doesn't mean that. So you need to see here, if this says some value above zero, it's as it shows right here, it's a disqualifying disposition. So don't let the long term fool you. E-Trade should fix that, but they haven't. Okay, just a couple other examples. This was this was an example of selling RSUs. similar thing. But you don't have the ordinary income since it was compensation immediately that was already taxed. But you could sell either ESPP or RSUs just to, to then go into a diversified portfolio, but sell the biggest losers or the the smallest winners. And that impacts your taxes that year best. And then you can also, now we'll go into how to do capital gain harvesting if you had a loss on something like ESPP or RSUs. Okay, in this case, let's say, and this sucks, but this was almost what happened to Viasat stock from until last summer when it started, unfortunately, going back up. The price, purchased at $100 per share, and the current price is $10 a share. So you've lost $90 a share. That sucks. Loss of is $4,050. And then you could lower, like I said, you could lower your taxable income that year by $3,000 and carry forward the other 1,050 for future years. Or let's say you had that VTI or some other stock or some other ETF or mutual fund that's been increasing in value. And let's just use the opposite. You bought it at $10 per share, and now it's at $100 per share. Now you sell 45 shares, you've got a gain of $90 per share. But the beautiful thing in this case, it's done in the same calendar year. Those $44,050 of losses you had equal out the $44,050 of gain right here. Then you could immediately buy back that stock, let's say VTI, so you liked it, and at a higher cost basis. Now you bought it, now you've got it at $100 instead of $10 per share. So then later on, when you want to use that money, and let's say it went up to $150 per share, now you're only paying $50 in gains by $140 in capital gains per share. And so there's no wash sale rule when it's a gain. There is, if you sell something for a loss and then try to buy it back, it's actually a 61-day window, 30 days before the sale, the day of the sale, and 30 days after. If you buy that same thing, they actually go, haha, nope, that's not a loss. And the wash sale rules come into, but not in a gain. In a gain, you've sold it, taken the capital gain, and then you could immediately buy it back that same day. And now you've just increased your cost basis so that later on, you're going to pay less long-term in taxes as it goes up in the future when you really want to use the cash. Questions there? That's kind of a next level topic, but it's important to understand. And Brittany and Avanti, if you guys have any or Jenny, like people that are also past the CFP exam, have any recommendations, any additional points, let me know.
I think you're
Okay.
covering it well. It is a little hard to hear you, though. I don't know if it's just me.
Is it? Okay, maybe I just moved it closer.
No,
Sorry
way
about that.
better. Yep.
Well, then tell me that from the beginning, people. Like, sorry. Just if you can't hear me or something, if that you can't the screens, you can't see it, just let me know. Thanks, Brittany. Okay, now here's a couple of facts about ESPP. So if you're terminated, you get your cash back within 60 days, what you've been contributing up to that point. If there's a death, the beneficiary can ask for cash, or it'll just be exercised as it would have been as a decedent planned. And then you can withdraw from the purchase plan no later than 10 days prior to exercise date. So, and then usually we'll see, I put that as homework, but the email comes out like if you're not currently contributing to the employee stock purchase plan, about 25 days, it's usually about the 5th of the month, so about July 5th, we'll probably see an email saying, hey, the open window is open now until, usually it's about 2 weeks, 15 days, and then it closes. So I'll put a note out when I see it, but if you're currently in the plan, it'll stick with exactly what percentage you are. But if you're not, that's the time to hit that window, which is during the month. But that window closes typically about 10, 11 days before the open window actually the purchase window actually begins. Okay, so homework, like I said, if you're not enrolled, look for the, or you're not at 5%, you want to adjust, or look for the email that this, it's like employee stock purchase plan, and you can, if you missed it, you can just search, your email. Then review your current status of your ESPP and RSUs and determine what best batches to sell. As I said, go for your biggest losers if you still have some, or your smallest gainers, and then you can do tax arbitrage by doing some capital gains harvesting if you want to do something else, uh, or you can take, up to $3,000 a year in losses against to lower your taxable income. Also, if you're not contributing enough to your 401k to get the max match, then adjust contributions, get free money. It looked like everybody here was already, so, okay, let's see what else. That's it. Now we're into questions. And there's the survey if you don't mind. Appreciate it. I've got some more complex problems, but I think there hasn't been any questions, but let me see what else. I'll just leave that up, but I'm going to stop recording now. And that way I know people tend to ask are more likely to ask questions when I stop recording. So if I can.